We are recording this analysis on April 25th, and I want to talk about something that I think is extremely important for people to understand. The question I'm going to address today is whether the war on Iran could lead to a financial collapse. And I know that sounds dramatic, but I'm going to explain why this is a very real possibility that we need to take seriously. Now, before I get into the details of the financial implications, I want to provide some context about what has been happening. The United States and Israel launched military operations against Iran at the end of February, and we are now 2 months into this conflict. And the economic ramifications are already being felt around the world. But what I'm going to argue today is that we have not yet seen the full impact of this war on the global financial system. In fact, we may only be seeing the tip of the iceberg. And if this conflict continues or escalates, we could be looking at a financial crisis that rivals or even exceeds the 2008 global financial crisis. So let me start by explaining the mechanisms through which this war could trigger a financial collapse. First and foremost, we need to understand the role of energy prices in the global economy. Energy is the foundation of modern industrial civilization. Everything we do, from manufacturing goods to transporting products to heating our homes, requires energy. And when energy prices spike dramatically, as they have done since this war began, that creates inflationary pressure throughout the entire economy. Now, inflation is not just an inconvenience. High inflation can destabilize financial markets in several ways. When inflation rises, central banks typically respond by raising interest rates to cool down the economy. And higher interest rates make it more expensive to borrow money. This impacts everything from mortgages to corporate debt to government bonds. And here's where things get really dangerous. We are living in a world that is drowning in debt. Global debt levels are at historic highs. According to the Institute of International Finance, global debt reached over $300 trillion. That's more than 3 times global GDP. And much of this debt was accumulated when interest rates were very low, near zero in many cases. Companies and governments borrowed massive amounts of money because it was cheap to do so. But now, as central banks raise interest rates to combat the inflation caused by skyrocketing energy prices, the cost of servicing that debt is going up dramatically. And this is where we could see a cascade of defaults. Companies that borrowed heavily when rates were low may find themselves unable to make their debt payments when rates are high. And when companies default on their debt, that creates losses for the banks and financial institutions that lent them money. And if enough companies default, banks can become insolvent. And we all remember what happened in 2008 when major financial institutions became insolvent. The entire global financial system nearly collapsed. Governments had to step in with massive bailouts to prevent a complete meltdown. And we could be heading toward a similar situation now. Except this time, the underlying cause is not subprime mortgages, but rather an energy crisis triggered by a war. Now, let me talk about another mechanism through which this war could cause financial collapse, and that is the impact on the US dollar. The US dollar has been the world's reserve currency for decades. And a key pillar supporting the dollar's dominance has been the petrodollar system. What is the petrodollar system? It's the arrangement whereby oil is primarily traded in US dollars on global markets. This creates constant demand for dollars because countries around the world need dollars to buy oil. And that demand for dollars helps to maintain the dollar's value and allows the United States to run massive trade deficits and budget deficits without facing the kind of currency collapse that other countries would face in similar circumstances. But as I mentioned in previous analyses, Iran has made a very strategic decision in response to this war. Iran has closed the Strait of Hormuz, and it is only allowing friendly countries to pass through, and only on the condition that the oil is traded in currencies other than the US dollar. Specifically, Iran is demanding that oil be traded in Chinese yuan, and this is a direct challenge to the petrodollar system. Now you might think, well, Iran is just one country. How much impact can that really have? But here's the thing. The The Strait of Hormuz is not just important for Iranian oil. 20% of all global oil supplies pass through that strait. That includes oil from Saudi Arabia, the UAE, Kuwait, Iraq, and other major producers. And if all of that oil starts being traded in yuan instead of dollars, that represents a massive shift away from the petrodollar system. And if the petrodollar system breaks down, demand for US dollars will fall. And if demand for dollars falls, the value of the dollar will decline. And a declining dollar creates its own set of problems for the US economy. It makes imports more expensive, which creates more inflation. It makes it harder for the US government to finance its massive deficits, and it could trigger a flight from dollar-denominated assets. Foreign investors hold trillions of dollars worth of US Treasury bonds. If they start to worry about the long-term value of the dollar, they might start selling those bonds. And if there's a massive sell-off of US Treasury bonds, interest rates will spike even higher, which brings us back to the debt problem I mentioned earlier. Higher interest rates make it harder to service debt, which increases the risk of defaults and financial crisis. So you can see how these different factors are interconnected. The energy crisis leads to inflation. Inflation leads to higher interest rates. Higher interest rates make debt harder to service. Defaults on debt can cause bank failures. Meanwhile, the breakdown of the petrodollar system undermines the dollar, which creates more inflation and makes it harder for the US to finance its deficits. And all of these factors feed into each other in a vicious cycle that could culminate in a financial collapse. Now, I want to talk about another dimension of this crisis that I think is not getting enough attention, and that is the impact on emerging markets. Emerging market countries are particularly vulnerable to the kind of financial crisis I'm describing. Many emerging market countries have borrowed heavily in US dollars. When the dollar strengthens, as it often does during times of global uncertainty, it becomes more expensive for these countries to repay their dollar-denominated debt. And at the same time, these countries are being hit hard by rising energy prices. Many emerging markets are net importers of energy, so when oil and gas prices spike, their import bills skyrocket. This puts pressure on their foreign exchange reserves and their current account balances. And if an emerging market country runs out of foreign exchange reserves, it can no longer pay for imports or service its foreign debt. And that's when you get a currency crisis. We've seen this pattern many times before. In the Asian financial crisis of 1997, in the Russian debt default of 1998, in the Argentine crisis of 2001, and we could be heading toward another wave of emerging market crises triggered by this war on Iran. And when emerging markets collapse, that has ripple effects throughout the global financial system, because Western banks and investors have exposure to emerging market debt. If emerging markets default on their debts, that creates losses for Western financial institutions. And once again, we're back to the risk of bank failures and financial contagion. Now, let me address an argument that some people make. Some people say, well, the US is energy independent now because of the shale oil boom. The US produces enough oil to meet its own needs. So why should the US be affected by an energy crisis in the Middle East? And I addressed this briefly before, but I want to elaborate on it because it's such a common misconception. Yes, the US does produce a lot of oil. The US is one of the world's largest oil producers, but that does not make the US immune to global oil price shocks. Why? Because oil is a globally traded commodity. The price of oil is set on global markets. US oil producers sell their oil at the global market price. And when the global price of oil spikes because of a supply disruption in the Persian Gulf, the price of oil in the US also spikes. American consumers have to pay more for gasoline, even though that gasoline might be refined from domestically produced oil, because the oil companies can sell that oil on the global market for a higher price. So they're not going to sell it domestically for less than they could get on the global market. This is basic economics. And this means that even though the US produces a lot of oil, American consumers and businesses are still very much affected by global oil price shocks. And those higher energy costs create inflation, which, as I've explained, can trigger a cascade of financial problems. Now, I also want to talk about the stock market because I think the stock market is particularly vulnerable right now. U.S. stock markets have been at or near record highs for years. Stock valuations are extremely elevated by historical standards. The price-to-earnings ratios of many stocks are well above their long-term averages, and this means that stocks are priced for perfection. They're priced on the assumption that everything is going to go well, that corporate profits will continue to grow, that the economy will remain strong. But what happens when that assumption is challenged? What happens when an energy crisis drives up costs for corporations, squeezing their profit margins? What happens when higher interest rates make stocks less attractive compared to bonds? What happens when investors start to worry about a recession? Well, we could see a major stock market correction or even a crash. And a stock market crash would have devastating effects on household wealth, particularly in the United States where so much of household wealth is tied up in stocks and retirement accounts. When people see their retirement savings evaporate, they cut back on spending. And when consumer spending falls, that hurts corporate revenues, which leads to layoffs, which leads to even less consumer spending. And once again, we're in a vicious cycle that could spiral into a deep recession or depression. Now, I want to be clear. I'm not saying that a financial collapse is inevitable. What I'm saying is that the risk is very real and very serious. And the longer this war continues, the greater that risk becomes. If the war ends soon and the Strait of Hormuz reopens and oil supplies return to normal, then maybe we can avoid the worst-case scenario. But even in that optimistic scenario, the damage has already been done. Oil prices have already spiked. Inflation has already accelerated. Central banks have already started raising interest rates. Supply chains have already been disrupted. And as I mentioned earlier, there's going to be a food crisis in a few months when the crops that weren't properly fertilized come up short. So even if the war ends tomorrow, we're still going to be dealing with the economic consequences for months or years to come. And if the war doesn't end soon, if it escalates, if it spreads to other countries in the region, then all bets are off. We could be looking at an economic catastrophe on a scale we haven't seen since the Great Depression. And I know that sounds alarmist, but I think it's important to be honest about the risks we're facing. Now, what can be done to prevent this? Well, obviously, the most important thing is to end the war. The war needs to stop immediately. There needs to be a diplomatic solution. The U.S. and Israel need to abandon their regime change agenda and accept Iran's sovereignty. But beyond ending the war, governments need to take steps to stabilize their economies and financial systems. Central banks need to be very careful about how they respond to inflation. If they raise interest rates too aggressively, they could trigger the debt crisis I described. But if they don't raise rates enough, inflation could spiral out of control. It's a very difficult balancing act. Governments also need to rebuild their strategic reserves of oil and other critical commodities. They need to invest in renewable energy and energy efficiency to reduce dependence on fossil fuels. They need to regulate financial institutions more carefully to prevent excessive risk-taking. And they need to provide support to vulnerable populations who are being hit hardest by rising energy and food prices. But I'm not optimistic that governments will take all of these necessary steps. Unfortunately, many governments are more focused on geopolitical competition and military adventures than on economic stability and the welfare of their people. And that's why I think the risk of financial collapse is very real. On that note, I want to conclude this analysis. The question I posed at the beginning was whether the war on Iran could lead to a financial collapse. And my answer is yes, absolutely it could. The mechanisms are clear. Energy price shocks lead to inflation. Inflation leads to higher interest rates. Higher interest rates make debt unsustainable. Debt defaults can cause bank failures and financial contagion. Meanwhile, the breakdown of the petrodollar system undermines the US dollar, creating additional inflationary pressure and financial instability. And all of this is happening at a time when global debt levels are at record highs and stock markets are extremely overvalued. We are sitting on a powder keg, and this war could be the spark that sets it off. I hope I'm wrong. I hope we can avoid the worst-case scenario. But I think it's important for people to understand the risks and to prepare accordingly. Thank you for watching.